Hey guys, it's Trader Main from Breakout. Welcome back to the free trading course for you, our Breakout community. This is the second episode. In this episode, we're going to focus on price action trading 101. So whether you're a new trader or an experienced trader just looking to refine your skills, this video will equip you with some concepts and strategies that you can start implementing in your charts and trading right away. Let's get into it. The first section of this video is about support and resistance. This is one of the more basic price action concepts. However, it's still very important. What we're going to be doing is visually looking at the chart and trying to identify areas where price might reverse or consolidate at. So I've got the breakout terminal open here and I've got the weekly chart on Bitcoin opened up. So we'll start trying to identify some weekly support and resistance levels. Keep in mind, you can find support and resistance levels on any time frame. They're going to be different based on the time frame that you're on. A good rule of thumb though is the higher the time frame, the stronger the level is going to be. So you might weigh a weekly support level higher than you would weigh an hourly support level. So looking at the weekly chart here on Bitcoin, you can start at any point. What's really nice about this is it's very much visual. There's not really any rules that are set in stone that you must abide by. You can use certain triggers like previous highs. Maybe it's an old weekly high. On Bitcoin, I think the old all-time high is usually a pretty good area, things like that. You could use a daily high, a daily low, the daily open, the daily close. These all work as support and resistance levels. However, you can do it as simply as just using your eyeballs and visually looking for levels where price has interacted a bunch of times. So jumping out at me right off the bat is going to be this previous kind of all-time high area. If you mark out this kind of all-time high area on Bitcoin, you can quite quickly see that it very much was a key level on this retest. So price ended up selling off here, coming up to that area, and that area acted as resistance. That could be a selling opportunity. Furthermore, when price came back to this area, you could see that price ended up consolidating around this level. That tells me that it's a good level. It's a good zone to be paying attention to. You can see we traded above, back below, above, back below, and then when we finally reclaimed it, it became support and price moved up aggressively. So that's just a very easy, quick visual level that I see using the previous all-time high. Let's see if we can find another one that would form the low. So I like this area right here. It's kind of these lows, right? Those highs that ended up causing the low here. So you can see price used this area as resistance, traded up, found resistance at the all-time high level, traded down, used it as support briefly, traded below, now it's resistance, resistance, flipped to support, support, and traded up. I'm not doing anything fancy here. I'm just visually identifying areas where price has interacted multiple times and seeing if I can project that out into the future and get a reaction later on. This is a really good example of using an old level here that, yeah, it was resistance here, and that ended up being the low of this last consolidation. So I'm not using any sort of specific candle. I'm not using any sort of stringent rule set. I'm just visually looking at the chart and marking off the levels. Let's try this again here on a lower time frame now. So now we're looking at the daily chart. Let's see if we can do the same thing. What levels jump out to you right away? I would say these highs here, pretty good level. Resistance multiple times. Price rejected, price rejected, price rejected, rejected, finally broke through. Now, logic would state if we do end up coming back here, I don't know if we will, I would anticipate this potentially becoming support. What was resistance can now become support. What once was support can then become resistance. Again, nothing fancy here, just marking out what I see visually. This looks to be like a pretty good area of support here. Price came down, bounced, it briefly lost the level, but reclaimed it, used it as support. Where did it trade up to? Resistance. Traded back down, briefly formed support, traded below, bounced, some resistance here, and then finally reclaimed as support and went off. Every time you draw a level, it's not going to be perfect. Just because you've identified a level of support, it doesn't mean that every single time price gets there, it's going to respect the level 100%. That would be too easy. However, by finding areas where you believe price is going to be sensitive at, and that's very clear here. This is very clearly a sensitive area in price. Price clearly is reversing often at this level or consolidating around it. It can be a clue and tool that you can use to frame trade setup. So it doesn't bounce every time it comes to this level, and it doesn't have to, but this is very clearly a good level based on price having some kind of reaction every time it gets there. So if you've marked out a support level and price loses that level like it did here, you could potentially consider taking a short when it tests it on the other side and seeing if that support has now become resistance. And the same is true on a reclaim. So you have a support level here and it's loss. When price gets back above that support level, you could potentially assume that maybe it's going to be flipped back into support and look for a trade idea. So there's not really a right or wrong way to mark your support and resistance levels. It's going to be different for everyone. What you need to do is take some time in the charts yourself and try and practice identifying levels where price is reactive. Now, what I've covered here are horizontal levels of support and resistance. This is primarily what I use in my trading. That being said, diagonal lines of support and resistance work as well. So I'll quickly show you some of those. Easiest one I see here is just from these highs being resistance. So you have this high, it's resistance, it's resistance, it's resistance, resistance, and then it reclaims and it ends up being support. Works the exact same way. You're just visually looking at the chart and you're trying to find areas where price may consolidate or reverse from. You could argue that you have another diagonal level here. That's a support level. So price bounces every time it gets down here. Yes, price is going down, but every time it comes to this level, it gets a reversal. It gets a reaction. So you can have both horizontal and diagonal support and resistance levels. And again, you can find levels on each different time frame. What you're going to want to do is identify high time frame levels and then work down to the low time frame and combine those to look for your trade setups. We'll talk about some other things that you can combine as well with support and resistance levels in a later section. This next section, we're going to talk about liquidity. Liquidity is simply where orders are resting in the market. What I'm going to show you is how I use the chart to identify areas of liquidity. All right, so we're back in the breakout terminal here, and we've got the Bitcoin daily chart open. So the primary way that I identify liquidity is above and below key swing points. So above old highs and below old lows. Now, similar to support and resistance, you don't have to have a strict rule set in terms of how you're identifying these swing points. It can be done very visually. However, there are a few things that if you want to use to identify liquidity, you can. You could use time-based liquidity, so using an old daily high or daily low, an old weekly high or weekly low, a monthly high or low, and so on. Stuff that I don't use but also does work are things like liquidity at support and resistance levels, liquidity on trend lines. All it is areas where people are placing their buy and sell orders. For the purposes of this section, we're going to simply focus on key swing points, key highs and lows where liquidity is going to be resting at. So just looking at the chart here visually, you can probably see a few of them jump out right away. You have a swing high here that is formed. Liquidity is likely above that high. Price runs above it, trades below. You have a swing low here form. Liquidity resting below that low. Price trades below. Reverse, same thing here. Swing high, price trades above, takes out the liquidity, and then sells off. Without getting into too much detail about what's going on at these actual liquidity levels, it's just buy and sell orders. So above an old high, the type of orders that are generally going to be resting there are buy orders, because if you are a trader and you're looking to short the market, so you think price is going to trade lower here, so you're short, you're probably going to put your stop at this high. If it's going to go down, it shouldn't go above this high. How do you get out of a short order? With a buy. So this would be called buy side liquidity. The inverse is true on the downside. If you're longing here because you think price is going to go up and up and up and continue up, and you have your stop below here, how do you get out of a long position? With a sell order. So sell side liquidity is what's below old lows. Buy side liquidity is what's above old highs. So how can you use this in your trading? Well, you can combine this with things like support and resistance and things that we're going to talk about later in this video. But the way that I generally use it is kind of based on trapped traders, failed breakouts, swing failure patterns. These are terms that I often use. And the simplest way to describe it is price is going to take out liquidity and use that as a way to generate a reversal. So let's get into that a little bit deeper here. Imagine you are short here. Price is trading down and down and down and down and down. At a certain point in time, this candle was large and red. Only after the fact did it end up closing as a wick. So if you're shorting this move and you think it's going to go lower and lower and lower, and then price wicks up and closes above like this and forms a swing failure pattern, and then starts trading up, you're now a trapped trader here. So you're short and you are trapped because price is now reversed the other way and it's trading away. There's also going to be people that are shorting this breakdown, thinking price is going to actually continue trading lower from here. So they're taking shorts as it trades lower here. Price reverses, they're now trapped as well. How do they get out of that trade? They're short and they're trapped because price is faked out, failed a breakdown, whatever you want to call it, below an old low. They're going to have to buy back. That generates upward price action, right? Buy orders cause price to go up. What else is also happening here? Well, we have this old low here. So anyone who is long on this way up, they're going to have their stop below here. What is the stop order to get out of a long? It's a sell order. So the people who are potentially on the right side of the trade, right? Not the people who are trapped, not the people who are long. How do they get into the trade that results in price moving up here? They want to buy. So where is that buy come from? It comes from someone who's willing to sell to them, because price, it's a zero-sum game. For every buyer, there has to be a seller. So if you want to be buying because you think price is going to trade higher, a great place to buy is below an old low because there's sell side liquidity there. There's sell orders resting that you can use to fill your long order. That, coupled with the trap traders who were taking the failed breakdown here, all generates buying pressure, which ends up sending price higher. So the way that I use this is kind of exactly as it's described here. I look for price to run liquidity above old highs and lows, and then I use that as a clue that we might be seeing a reversal. You can actually combine this with something we talked about in the last section, support and resistance. So if you have a resistance level here, not only do you have resistance, so I think price might reverse here, I know that there is going to be buy side liquidity that I could sell into above this old high in the form of someone's stop loss. I also know that there's going to be people who are buying this breakout and end up getting trapped, and they have to sell to get out of their order, which again is just going to be the inverse. It's going to generate sell side pressure. So that's how I use liquidity at a very basic level. I'm identifying key highs and lows where liquidity might be resting in the form of stop orders or just orders in general. And I'm using that as a way to frame my trade idea and ideally trade reversals. I mentioned earlier there's time-based liquidity as well. In this instance, this is just an old daily low. You could use the weekly chart and you could assume that below a weekly high and low, there is going to be liquidity. So we ended up trading all the way down here and we traded below two old weekly lows here. We traded below this weekly low. We traded below this weekly low. So there's going to be liquidity resting on all different time frames above key highs and lows, at areas of support and resistance, at trend lines. But the way that I use it primarily is to frame trade ideas of after the liquidity gets run, I'm looking to take a trade in the other direction. Later in this video, we're going to be combining a lot of these concepts, support and resistance, liquidity, and some other things we'll discuss to really help you hone in on how you can use this in your trading. In this next section, we're going to discuss order blocks. Order blocks are a price action concept that I use to identify areas where I can potentially enter trades. I use bullish order blocks to look for long entries, and I use bearish order blocks to look for short entries. Simply put, a bullish order block is a down candle before price moves higher and breaks market structure. A bearish order block is an up candle before price moves lower and breaks market structure. I then wait for price to retrace into the order block and I look for a trade. So let's get into the chart and I'll show you exactly how you can identify them. So we're looking at the Bitcoin daily chart here. And first we're going to cover a bullish order block. So a bullish order block is a down candle before an up move that broke market structure. The idea here is that down candle where price is selling off that then results in price trading higher. When price retests that level, we can assume that it should act as support and therefore we can take a trade setup off of it. So looking at Bitcoin here, we can actually see we have a down candle here on Bitcoin. So we mark the entire candle from top to bottom, and then you project it forward in time, and price broke market structure after that down candle was formed. So you have a down candle, a red candle, and then immediately after buying occurred, and the buying was strong enough that it broke a previous high. It broke market structure to the upside. So the concept is that because this down candle was the last area of selling before price went higher, the orders that were put on here to send price higher should be defended, meaning that when price retests that zone, it should act as support. So you can see here, we had the down candle followed by an up move that broke structure. Price comes down and you wait. You don't enter right away. You wait until price retests the order block. You can see it do that here, and then you can see the resulting reaction. So the way that I actually trade these, quite simply, is by entering with an order at the order block, and my stop goes below it. So you put your entry right at the order block, you put your stop below, and you take the trade. So you put a limit order. As soon as you see price break market structure, you put a limit order at the order block there, and that's the entry that you take. There's different ways you can get into this trade. You could have an entry at the top here for the full position. You could have 50% of the position at the top. You could have another 50% at the midpoint of the order block. You can zoom in on a lower time frame and try and get an even tighter entry with a tighter stop within the order block. But the basic idea here is because this down candle resulted in an up move that broke market structure, we expect it to act as support on a retest. We're going to look to be a buyer on that retest, whether you want to enter on the order block itself or just use it as an area where you're going to look for a long setup to form. It's up to you, and there's a variety of different ways that you can do it, but the simplest way to trade them is exactly as I'm showing you here. So again, we have down candles here that led to an up move. You can combine the candles like this if you want. As long as they're consecutive, it works fine. Down candles that led to an up move that ended up breaking market structure here. So you're not entering immediately, you're waiting. It breaks market structure. We now know that the order block is valid, and you wait for price to come back. You set your entry there and your stop below the order block, and you can see the result. This is a very good example here of where you could potentially try and get a better entry. Within this order block, what did we have from the last section? We had a swing low that got run and it formed an SFP. So we had liquidity get run within the order block. That's just more confluence that our trade idea might end up being correct. And as I talked about in the last section, you're going to be able to combine all of these concepts together to get more confidence and more confluence in your trade idea. Now, just because you have an order block, it doesn't mean it's going to work every time. Price just as much could have traded right through this thing. However, more often than not, and because we use risk management, we're able to take these trades and usually have a positive expectancy. Let's see if we can find one more example of a bullish order block, and we'll find one that didn't work. So here's a down candle before an up move that broke market structure. Down candle, there's your move up that broke market structure. Price comes back, you buy. And in this instance, it doesn't work. So you can see here, everything we wanted to see happened. We had the down candle, the break in market structure, we got the retest, and in this case, it didn't work. It's not going to work every time. Are there things you can do to make it more likely that it's going to work out? Of course. You can find order blocks near support and resistance levels. You can find order blocks based on the higher time frame. You can find an order block that also has a liquidity event within it, like I showed you in the last example here. Those are things that you're going to get better at as you continue to trade and you continue to apply these concepts and you practice. However, at a very basic level, it works just how I showed you there. It's not going to work every time, of course. Nothing works every time in trading. Otherwise, it'd be easy and everyone would be super rich. So let's look at an example of a bearish order block. So right here, we have an up candle that caused price to trade down and break market structure to the downside. We wait. Price sells off. It breaks market structure. We don't short here. We wait for price to retest the area. Lo and behold, it comes up to the order block, and then it ends up selling off. Similar to that other example, we also had a liquidity sweep within the order block. More confluence, more confidence that this setup might work out. You have another one over here. You have an up candle right here. Again, we're combining in this instance here, and that's okay because they're consecutive. An up move that broke market structure. Price trades down, comes back up, retests, takes liquidity within the order block, and then sells off. So this is something you're going to see repeat all over all the time across a variety of different charts. As you get better at trading, as you practice these concepts, you're going to find ways to refine them and pick which order blocks and which instances and conditions work better. Here's an example of a bearish order block that didn't work. You have an up candle, price moved down, it broke market structure, came back retest, and it just traded higher. It didn't work. It's not going to work every single time, but there's things that you can do to get them to work more often, and that's going to include the stuff we talked about earlier in this video, support and resistance, liquidity, and some things we're going to talk about later in the video as well. So to summarize, a bullish order block is a down candle before price moves up and breaks market structure. You mark it out, and then you're looking to buy on the retest. The inverse is a bearish order block. It's an up candle for a move down that breaks market structure. You forecast it out, and you're looking to sell on the retest. Next up, we're going to talk about a price action concept called a breaker. A breaker combines both of the last sections together. It's a type of order block, but it also involves liquidity. The easiest way to visualize it is a breaker is a failed order block. So a bullish breaker is a failed bearish order block, and a bearish breaker is a failed bullish order block. I know it sounds a little confusing, but when I show you in the charts, it's all going to make sense. Let's hop over there. So to explain breakers, we're looking at Solana here on the 4-hour chart. So how I described it is it's a failed order block, and it takes into consideration liquidity. So what do I mean by that? Right here we have a up candle before a down move. Now this has all the makings of a bearish order block. It's an up candle before a down move that broke market structure. So using what we talked about in the order block section, you would think, okay, I'm going to actually be shorting this because it's a bearish order block. So price trades below, you're going to short here with your stop up here. The reason it's called a failed order block is because it's exactly that. This bearish order block failed at its job. It didn't cause price to reject. It actually ended up being a perfect support level, which caused price to trade higher. So a failed bearish order block is a bullish breaker. Where does liquidity come into this? So when an order block fails, there was still a liquidity event. Whether you're talking about breakers or order blocks, liquidity is getting taken in either scenario. In a bullish order block, we break an old high. That's taking out liquidity. We retest it, and then we move price higher. Breakers are commonly found at areas of a reversal. So that break in market structure, that actually ends up being a liquidity run. It could be an SFP. Traders get trapped, like we talked in the liquidity section here. So instead of viewing this as a bearish order block, really what we're seeing here is price moves down. It takes out this low, trapping traders, and then it trades away, and then this area ends up becoming support. So a failed bearish order block is a bullish breaker, and a bullish breaker takes out sell side liquidity, and then it breaks market structure in the other direction and becomes support. So how do you know if a bearish order block is going to become a bullish breaker? There's no way to know for sure. You could very well have shorted this expecting it to be a bearish order block, but then when you're proven wrong, you simply treat it like a support and resistance flip. From the first section, if you remember, we had support, it lost support, and then it reclaimed. Okay, so it was resistance here. Maybe you try and take a short, it doesn't work, it reclaims its support again. The same concept works here. So you assume that this is a bearish order block, you're proven wrong. Now you know it's a bullish breaker, and you can take the trade in the other direction. A further way that you can refine this is by using the bigger picture of the chart. We've been trending down here for a while. The likelihood that this is going to continue to sell off might be decreased based on the fact that we've already sold off a lot, and we're also coming into an area of support. So we're coming into an area of support after selling off a lot, and we've run a bunch of liquidity in the form of these old lows. So that might give you the clue that, hey, you know what? I'm not actually going to short this. I'm actually looking for this to be a bullish breaker. Now you can get more in depth in ways to determine, hey, is this going to be a bearish order block or a bullish breaker? But again, combining the concepts that we talked about earlier in the video, liquidity, support and resistance, things like that, it can help you identify when a order block might end up failing and becoming a breaker. Generally, these occur at old highs and lows. Again, going back to liquidity, and breakers usually form reversals. So that was a bullish breaker. Now let's find a bearish breaker. A bearish breaker is going to be a failed bullish order block. So you can see one here on Solana as well. Down candle before an up move that breaks market structure. This is a valid bullish order block, but you can see we ended up failing to find support here. It actually traded below and it ended up working as resistance and price sold off. You trade it the exact same way that you trade an order block. So if it's a bearish order block, you're looking to short it, you're going to put your entry at the breaker and you're going to put your stop above and you're going to target lower prices. Now again, how did we know that this bullish order block was going to end up becoming a bearish breaker? You never know for sure. However, using the rest of the chart and other context, you could perhaps make the estimation that, hey, we're trading here and we've just taken out a major high. So maybe price is going to reverse because we've taken out the liquidity above us. Where's the next area of liquidity? Oh, it's actually below us. So maybe instead of buying this, I'm going to be looking for selling. Now you'd be completely fine actually taking along here if you wanted, because it is a valid order block. But if you're wrong, again, going back to the previous example, you can now say, okay, this failed as a bullish order block. Now I'm going to take a short off of it as a bearish breaker. So to summarize, a breaker is a failed order block, and you can use them generally to find reversals. Price will take out an area of liquidity, break the order block, break the other way, and then it becomes a selling or buying opportunity in the opposite direction of the original order block. Now we're going to talk about fair value gaps. So fair value gaps are inefficient price moves. So when price moves in an inefficient way through an area, generally it's a fast and thin move that leaves a wide candle body opening. That is an inefficiency in the market. It's an imbalance. And what price likes to do is return to those areas and fill in those fair value gaps. You can understand how that might be important because it can be an area where you look for trade setups or you look for price to draw to if you're already in a trade in the form of a target. Let's get into the charts and I'll show you some examples. Similar to order blocks and breakers, there can both be bullish and bearish fair value gaps. A bullish fair value gap is formed after an inefficient move to the upside. A bearish fair value gap is formed after an inefficient move to the downside. The rule of thumb when identifying a fair value gap is it requires 3 candles. The inefficiency is going to be the area between the low or high of the first candle and then the low or high of the third candle. Here's an example on the Solana 4-hour chart. So you can see we have this very fast, inefficient move to the downside. Price leaves this large body candle and it never trades back within it. That is a bearish fair value gap. So it's identified from the low of the first candle to the high of the third candle. So you can see here, this is a thin area of price. It was inefficient. Price moved down. And just like I mentioned in the first part there, this will often act as a magnet or a draw for price because price wants to come back and it wants to fill in that inefficiency. So you can see here, price trades lower after that inefficient move. And then it comes back up and it tags that inefficiency. Like I said, this can be used a couple of ways. If you're longing here, perhaps you took a long based on this bullish breaker. Up candle for a down move, failed as a bearish order block, it becomes a bullish breaker, and you target the inefficiency because price is likely going to draw to that fair value gap. Another way that you can use it is to look for a setup itself. Just like a bearish order block or a bearish breaker, fair value gap can be an area that price rejects from. You see price trade up to this fair value gap here, takes out liquidity within the fair value gap, and there also happens to be a bearish order block here as well. So you have multiple confluences lining up here as, hey, price might reject here. And as you can see, price comes up, tags the fair value gap, takes the liquidity, it also tags the order block, and then it sells off. If you're going to trade the fair value gap itself, you treat it just like an order block or a breaker. You can put your entry right at the edge and your stop right above it. So in this instance, it would be a short with your entry here and your stop up there. Let's find an example of a bullish fair value gap. So you can see here, price is moving aggressively to the upside, but this candle specifically is a wide body candle that is inefficient in that price does not fill it in at all with any sort of wicks. It's one-way price action. Mark the high of the first candle to the low of the third candle extended out in time, and you can see price traded away after that fair value gap, and it was drawn all the way back down to the fair value gap to draw on price. Perhaps from a short order up here, you could target this fair value gap down here, or you could use it as a potential area of support. Similarly to the last example, there's also a bullish breaker that forms right around there. What you're going to see by the end of this series is lots of these things I'm teaching you, they'll line up at the same time, giving you more confluence and therefore more confidence that your idea might play out. The more of these concepts you can line up at the same time for any given setup, the better. Let's do a couple more examples here. So we have a big bullish fair value gap right here, the high of the first candle to the low of the third candle. I'm not saying we're for sure going to come down here, but if we were to start selling off, right, let's assume, hey, price is going to distribute, it's actually going to come lower. We get some sort of big flush on Bitcoin. This would be a draw on price for me because of the bullish fair value gap down here. And this could be an area that we could then look for price to bounce and reverse and potentially trade higher. This section, we're going to talk about multi-time frame analysis. When you're doing your charting, you need to start with the higher time frames first to determine what your key high time frame levels and areas of interest are, and ultimately what your directional bias is based on the high time frame, because that's the one that carries the most weight. Do you think, based on the high time frame, that we're bullish or bearish? Are we going to trade higher or lower? Once you've determined that and you've marked out your high time frame areas of interest, your support and resistance levels, your liquidity, your order blocks, etc., you can then zoom in to the lower time frames to take your actual entries. If you remember from the previous sections, I talked about using multiple pieces of confluence to make your trading setup more likely to play out. Some of those confluences are a high time frame bias. How do I know a bullish order block is going to work? Well, if I'm high time frame bullish and I'm at a high time frame support level, the likelihood of that bullish order block on the low time frame playing out is much higher. Let's get into the charts and I'll show you an example. How do I do multi-time frame analysis? Generally, when I pull up a new chart, before I worry about marking up support and resistance and order blocks and looking for liquidity, the first thing that I'm doing is I'm trying to determine what the trend is and what my bias is. So looking at Solana here, I'll usually start on the higher time frames. The monthly, the weekly are pretty much as high as you need to go. Crypto moves pretty quickly. Sometimes the monthly is even quite slow, so you can get away with the weekly being your highest time frame. We'll start on the weekly here for Solana. It's very clear that the weekly is in an uptrend. We have a low here and then a high, and then we have a higher low and a higher high and a higher low and a higher high and a higher low and a higher high. So the weekly chart is very much in an uptrend. So my weekly bias is bullish. My expectation is that any sort of pullbacks on the weekly chart are going to eventually form a higher low, which they did, and lead to continuation of the trend. Obviously, we had a period here where we were going sideways for several months, but the trend leading into it was bullish, and we never made bearish market structure on the weekly. So my high time frame view was bullish. Now that you have that figured out, you can then start to mark out some high time frame levels. We have a high time frame bullish order block here, and you can make these different colors. You can label them anything you want so you can differentiate when you're on the lower time frame which is which. So perhaps on this one, I'll say, okay, this white order block is the weekly order block, and I know that we're bullish on the weekly. I know that we are high time frame bullish, so when I zoom into the low time frames, I have that in mind, and it's going to help with my decision making as I go down. We also have a very nice support level, I would say right around here, wouldn't you say, on the weekly as well. So we have a weekly support level, and we have a weekly bullish order block, and we're bullish on the weekly. Going down to the daily, now you can see why this is so important, because on the daily chart, without that weekly view, you might say, well, damn, this looks not so good. We're making lows here, we're selling off, it looks weak, we made a lower high here, we're selling off again. So every time we get down to this area that you know from the weekly is support, if you're just looking at the daily chart, you might think, oh, eventually this thing's gonna roll over. It's not trading higher, it's consistently making lower highs, and it's testing the support a whole bunch of times. I expect this to eventually break. So every time we come down here, maybe you're waiting to take a short and it breaks down, you short, you get stopped out. It breaks down a little, you short, you get stopped out again. But with with that high time frame bias being bullish, I know that even though the daily chart might be in a temporary downtrend, every time we come down here, we're into weekly support and the weekly is bullish. So that allows you to say, okay, well, I'm actually going to have a daily bullish bias based on the fact that the weekly is bullish. We have a weekly bullish order block and a weekly SR level. So next time we come down here and we actually end up putting in an SFP, maybe you take a long after it runs that liquidity. Maybe this is a bullish order block right here. You say, you know what, I'm going to take a long on this because yeah, it's a bullish order block, but I'm confident that this daily bullish order block is going to work because it occurred near weekly support, above a weekly bullish order block, and the weekly trend is up. And you can see obviously the result there. That ended up being the bottom, as that traded much higher. And you can go down even further, keeping this same bias in mind. So we have this weekly bullish trend, weekly support. We have a daily bullish order block, and I'm going to make this one blue. Daily bullish order block. So we're bullish and bullish and bullish on the high time frames, and we zoom in even again. And now within this daily bullish order block, again, the H4 is very noisy. Oh, is it going down? Like this might look bearish to you. If you were only looking at the H4, this looks kind of bearish. Fully retrace that move, made a lower high. Maybe you're shorting this, expecting it to break down, when in fact, this is actually coiling up to break up and trade to new highs. So knowing that our high time frame is bullish and we're layering these time frames on top of each other, we're doing multi-time frame analysis, starting from the top, the higher time frames, and moving down. Now on the H4, we have a bullish order block and a bullish breaker within our daily bullish order block on top of our weekly support. So now, like I talked about earlier, we have multiple layers of confluence, not just in terms of concepts, but in terms of time frames as well. And you actually end up getting a H4 bullish order block right there, where now instead of having your stop all the way down here on the weekly or all the way down here on the daily, you can enter based on this order block here with a much tighter stop, but the reaction you get is very strong because all the time frames above you are synced. You have top-down time frame analysis done. All of your biases from the higher time frames down to your low time frame where you're executing are in line with each other. That means it's more likely that your trade idea is going to work out. So a 4-hour order block on its own might give you an okay reaction. A 4-hour order block on top of a daily order block on top of weekly support where everything is bullish is going to give you a really big reaction. So that's how you can use top-down analysis to increase the expectancy of your trades. When you're taking a trade on the low time frame and it's in line with your high time frame bias, it's not only more likely to work out, but it's more likely to give you a larger move because there's the higher time frame backing it up. So this is how I do top-down analysis, and this works on any time frame. I generally stick to the weekly, the monthly, the daily, and then I'm executing on the H4 or the H1 like you see here. But you could use the daily as your high time frame and then the H4 as a high time frame, and then you could execute on the 15-minute. If you're scalping, maybe the H4 is your high time frame and the H1 is your medium time frame and the M15 or M5 is your low time frame where you're executing. It's up to you. It all works the same. As long as you're doing it top down, you're going to have better results. So that's it for price action trading 101. I hope you can see how the last section there with multi-time frame analysis really ties in everything from the beginning. Support and resistance, order blocks and breakers, fair value gaps, liquidities, they all line up on top of each other. And when you use them in confluence with top-down analysis, you can get some really amazing trade setups. I highly suggest you implement some of these concepts along with top-down analysis into your charting and trading and see if it gives you better results. The best way to practice this is getting in the charts and doing it for yourself. Watch this video a few times, take some notes, go into the charts and try and identify these things on your own in your own charts. The best way to learn in trading is by doing. I hope you enjoyed the video. We'll be back with another one soon. Talk to you guys then.